Hi, my name's David W. Klossing. I'm a duly licensed tax attorney and CPA, and I'd like to talk to you about international tax compliance and offshore reporting. Listen, if you have undisclosed foreign financial accounts that have been receiving unreported income from offshore investments or offshore business interests, and you think the IRS won't find out, think again. Modern reporting systems dictated under FATCA and the FBAR give the government multiple ways to trace offshore activity, compare data, and flag mismatches between your return and offshore income. When that happens, what started as a simple oversight can quickly escalate into massive penalties, or even criminal tax and offshore information reporting fraud exposure. I'm an international tax attorney and CPA. My team and I help clients across the U.S. and expats internationally manage cross-border tax issues, restore compliance, and we protect communication and work product privilege when the IRS starts asking questions. If you are a U.S. tax resident, whether you're an individual offshore investor, a business owner with foreign partners, or someone who recently worked overseas, you're required to supply the required information reporting on certain foreign financial accounts and offshore income-generating assets. And listen, your worldwide income is taxable for federal and state purposes, even though you're paying tax offshore. These include foreign bank account or brokerage accounts, interest in offshore partnerships, offshore corporations, or even foreign pensions and trusts that may be non-taxable over there but taxable over here. FATCA, the Foreign Account Tax Compliance Act, requires U.S. taxpayers to disclose specific foreign financial assets on Form 8938 when value exceeds certain thresholds. At the same time, the FBAR, filed with FinCEN, requires anyone with more than $10,000 aggregated in offshore foreign financial accounts at any point in the year to report them electronically. These two regimes often overlap, and missing either one of them can trigger painful penalties. Listen, the IRS has made an offshore compliance one of its top priorities. It now receives account information directly from foreign banks and governments, plus analytics from prior filings. The IRS Criminal Investigation Division opens thousands of new cases each year and consistently reports conviction rates nearing 90%. That's why early disciplined action is critical if you've missed a filing or suspect your accountant has. Here's where most taxpayers get tripped up. Unreported foreign financial accounts in investment funds or business funds, especially involving passive foreign investment companies, PFICs. Interest in foreign corporations or partnerships without filing forms 5471 or 8865. Foreign trusts or gifts not reported on Form 3520 and 3520A. Transfers of property to or from entities without filing Form 926. Having digital assets held on offshore exchanges. If your non-compliance was non-willful, good news. Programs like the Streamlined Filing Compliance Procedures let you file 3 years of amended returns, pick up the unreported offshore income, 6 years of FBARs, and whatever else type of reporting requirement. With a proper non-willful certification, no criminal problem. If the conduct was willful, the IRS Criminal Investigation Division voluntary disclosure practice will still provide a way to resolve the case while avoiding criminal tax and foreign information reporting fraud. If you act fast and disclose truthfully. Listen, accountants can certainly crunch numbers, but their communications with you are not privileged. Once the IRS audits or criminally investigates, everything they've seen, said, or heard can be subpoenaed, and this can make them government witness number one against you. An attorney, on the other hand, can protect communications and work product under attorney-client work product privileges, and can even extend that protection to the accountants working for them under a COVEL agreement. Privilege can make the difference between solving a problem quietly and privately and finding it out publicly, especially where tax and disclosure fraud are at issue. Our firm combines tax attorneys and CPAs in one coordinated unit. Our CPAs are employed directly by a law firm, which results in privilege directly extending to their communications of work product privilege, especially where a criminal tax issue is at stake. We control any contact with the IRS, we verify the posture of the case, and build a defensible, factual, and legal record before anything escalates. Whether your situation involves foreign corporations, offshore digital assets, offshore trusts, withholding issues under FATCA, whatever it is, we develop a strategy tailored to minimize penalties and, by all means, keep the matter simply civil. If you received a notice about unreported foreign assets, or you simply want to make sure you're compliant, don't wait. Reach out today to our team of duly licensed tax attorneys and CPAs who understand international tax compliance and international information reporting and the importance of privilege. Visit Clossingassociates.com or call 1-800-681-1295 to schedule a reduced rate initial consultation. Taking that first step can save you years of stress, money, and potential criminal tax and foreign information reporting fraud exposure.